Hello, and welcome back to your next lesson of the Accelerated Investor Program with me, Warren Jeffrey. In our last lesson, we looked at how to protect your wealth with precious metals. You learned that there are several ways that you can invest in precious metals like gold, and that for your million rand portfolio, you need to allocate 5% to the new gold ETF. Now, today we're going to be looking at how you can invest to make sure you never ever run out of money. And it's easier than you think when you're invested in the specific assets I'm going to introduce to you today. We'll allocate 30% or 30,000 Rand of our million rand portfolio to these insurance assets. Let me explain. With the Rand weakening, petrol prices climbing, electricity and labour rates increasing, the price of everything rapidly climbing, inflation is becoming an ever-increasing threat to your wealth. And that's why it's so important you have investments in your portfolio that will not only reward you with great income, but also generate income that will keep pace with inflation. So, let's get started. The first insurance asset type is great to generate income because it allows you to profit by loaning companies money and then cashing in on interest payments from your loan. Let me explain. When a company needs to raise money for its business, one of the options it can use is to issue something called preference shares. Essentially, a preference share is the equivalent to a loan to the company, but instead of you having to loan the company the entire amount it needs, you can simply buy a preference share. This share represents a small portion of the loan and allows the company to take a whole bunch of smaller loans from investors to raise the total amount it needs. The company then pays the preference shareholders a set amount as a dividend. This can be seen as the interest payment on the loan. So, why would you want to invest in preference shares? The main reason is because, unlike regular shares, these shares tend to be very stable in value and offer you a safe and secure income investment. In fact, the right preference share can also offer you much better returns than you would earn in a regular, safe money market account. So, what is the right kind of preference share? Well, right now, with interest rates at record low levels and the Reserve Bank talking of increasing interest rates, it's a perfect time to buy what are called prime-linked preference shares. These preference shares pay out a dividend that is linked to the prime interest rate set by the Reserve Bank. So, when the prime interest rate is raised, you'll earn more from your investments in the form of an actual cash payout. On top of this, you'll also get capital growth on your investment as more investors buy these preference shares to secure this rising income. You can expect to receive around 70 to 80% of the prime interest rate paid out to you on your investment amount each year in the form of dividends. To take advantage of this income stream building asset and to grow your own 100,000 Rand portfolio into a million Rand, you need to allocate 10% or 10,000 Rand to prime linked preference shares. Now, the next insurance asset you're going to add to your portfolio is an asset known as InflationLinked Retail Savings Bond. The bond is effectively a loan to government, and the principal amount you invest is, unlike investing in a share or commodity, guaranteed. So, how does an inflation-linked bond work? The money you invest in an inflation-linked bond will increase in value every 6 months, in line with inflation. To determine this inflation rate that your money will increase by, you need to look at the CPI, or the Consumer Price Index. This is the official measure for how inflation is growing. Then, on top of the inflation adjustment to the capital amount you invested, you'll be paid an interest payment twice a year on the 30th of November and the 31st of May each year. This payment will go straight into your bank account, and it's calculated on your inflation adjusted capital. This rate is a 6-monthly floating real interest rate, being the difference between the normal interest rates and CPI rates. The floating real interest rate is derived from the government's inflation-linked bonds yield curve, as traded on the Bond Exchange of South Africa and calculated separately by the National Treasury for the various terms. Wow, what a mouthful. This all sounds pretty complex, I know, but simply put, the capital growth and interest you receive on your inflation-linked retail savings bonds mean your investment is guaranteed to grow ahead of the inflation rate, whatever happens. For example, let's assume you invested 10,000 Rand and inflation is 10%. In the first 6 months, your inflation-adjusted capital grows to 10,500 Rand, calculated as 10,000 Rand plus half the annual inflation rate, which equals 5% in our example. In this case, your interest returns will be calculated on the 10,500 Rand. Then, over the next term, 6 months, your 10,500 Rand will be inflation adjusted again and could increase, for example, to 11,025 Rand, depending on the Consumer Price Index or CPI rate. The interest payment for the next 6 months will then be calculated on 11,025 Rand, and so it will continue, all the way to the maturity of the bond, 3, 5, or 10 years, where the inflation-adjusted capital will be repaid to you in full. As you can see, each year, your capital you invested grows with inflation, and you get paid out an interest payment. This is why inflation-linked bonds really do give a great way to make sure you never ever run out of money. To take advantage of the second income stream building asset and to grow your 100,000 Rand portfolio to R1 million, you need to allocate 10% or 10,000 Rand to inflation-linked bonds. The last insurance asset we'll add to our portfolio is hard cash. Why? Well, it's simple really. When it comes to taking advantage of the different opportunities on the market, cash really is king. This is because by having some free cash, not tied up in different investments, whenever you see an opportunity to profit in any of the assets we've already covered in this program, you'll be able to quickly act and get into these opportunities. Holding some cash is also perfect to help you get through any ups and downs you might encounter in life without having to sell out of any of your investments. So, make sure you have 10% or 10,000 Rand of your 100,000 Rand portfolio in cash. You can keep this money in a simple money market account so that you'll earn some interest on it while still having it easily available. So far, we've allocated 95% of your 100,000 Rand into assets that will deliver you your R1 million portfolio. Now, the last 5% of your portfolio will be going to something really exciting. In fact, it's the professional secret tool to fast track your portfolio growth. So, make sure you join me in the next lesson of the Accelerated Investor Program to find out all about it. Until then, here's to staying ahead of the game.